Thank you, Chrissy, and thank you, everyone, for turning up. I know it's a bit early for a Singapore audience, but it's not a bad crowd. First of all, I'd like to thank Stuart and all the Vertical Events team. They've been our partners in this journey over the last year or two, and I've been to a lot of conferences over the years, but I'd never realized all the work that goes into behind the scenes to make it work properly. And they do a great job, and they've been good partners, and I've probably seen a bit too much of Stuart over the last couple months, so I won't be too sorry not to have him calling me every day, but they've been a great help making this thing work. The vision for this conference really came from the fact that I've lived here for 20 years and been to a lot of pretty average conferences, and so we were thinking, why don't we try and create an event that we would find interesting and that we would be interested in attending. And so hopefully some of you find some interesting things over the next few days. We've got a great group of keynote speakers, as Stewie mentioned. We've got some great expert panels and pretty interesting companies. So hopefully you get something out of it. But a quick infomercial about Tribeca. As Chrissy said, we're a 25-year-old firm. We started in Sydney. We're very Australian at the core, despite my Canadian accent and our New York-sounding name. We manage a number of fund strategies in Australian equities. We do a lot in global natural resources, and we have some thematic funds, one of which is our nuclear fund run by Guy Keller down here. You'll hear from him on a panel later. We run a couple of Asian funds here in Singapore. We have an Asia credit fund that John Stover runs. You'll see him later. That's the best performing credit fund in Asia. And last year we launched an Asian infrastructure fund that's managed by Suzanta Mazumdar, who I think is on tomorrow. So there's a few Tribeca people kicking around. We've got our group CEO, Adam Lavis, here as well, and our head of marketing, Alex Lupus. He's got a stack of investment subscription forms that are pre-filled, so you just have to sign them. So he'll come and find you over the drinks session, probably later on. Anyway, so that's us. And when we were thinking about what to talk about today, I was thinking back to a year ago, and things have changed quite a lot in some ways. I mean, lithium prices were down 80% last year, which has been impactful for a lot of people that attended. But in a lot of ways, some of the big themes are still the same. And so we've got, we would call them three big investment themes at the moment, and we wanted to talk a little bit about how they seem quite different, but they're actually quite connected. So energy transition and decarbonization, obviously it's quite relevant to this event. There's been decades of debate and disagreement around climate change, but in the last number of years, a consensus has been reached, both publicly and privately, that something needs to be done. And electrifying transport and industry and reducing the carbon intensity of power generation and just generally incentivizing society to reduce carbon. This is a big, big theme, and all of these things require massive amounts of capital and will take years to execute. Another big theme is onshoring supply chains. We're living in a time of geopolitical tension that's really unprecedented since the Second World War. And with China challenging the US for global superpower status, that's created this incentive for Western governments to realize that it's unwise to concentrate supply chains in China. And so we're seeing massive amounts of investment onshore. We're seeing a renaissance in manufacturing, and I think alongside a growing realization, particularly among Western governments, about how far advanced China is in terms of technology and every other aspect. And then, of course, you can't talk about big investment themes without talking about AI and big tech. They get more airtime than any investment theme at the moment. I guess I could throw crypto in there too, but it's not that kind of conference. The big tech has dominated investment flows for years. And AI is a more recent phenomena as the technology has matured, and we've seen the public become more exposed to it through things like Chat GPT. And in some ways, the hype is absolutely justified. I mean, technology has fundamentally changed many, many parts of our lives, and AI will disrupt pretty much every business out there. But when you look at how the money is flowing into these themes, it's actually quite narrowly focused. So if you look at energy transition and decarbonization, on the one hand, you have very large institutional investors looking for big infrastructure type investments. So big ticket, stable returns, reasonably low internal rates of return. And so that's for pension funds and sovereign wealth funds and these big institutional investors. And then at the other end, you have a lot of new climate tech venture capital money. And Bill Gates' Breakthrough Energy Ventures is probably one of the most prominent investors. And they've brought the venture capital model to this space where you make a number of bets, and most of them won't pay off, but the ones that do will become pretty big businesses. In onshoring supply chains, this is very much a government game. So you have these so-called helicopter money from governments supporting the private sector, building downstream infrastructure, either onshore or in friendly jurisdiction. And the money is big. I mean, the IRA alone is estimated to put over $800 billion into the US over the next few years, and the EU, Canada, Australia, every other Western country are all committing billions and billions of dollars in grants and loans and tax credits and everything else to support this onshoring. And they need to. It's the only way the West has a chance of catching up to China's head start in some of these industries. And then for AI and big tech, this is very much an equity game. So the flows into the Magnificent Seven has had a lot of press. It is unprecedented for 7 stocks to be 30% of the S&P 500. And there's been a similar frenzy in private markets, driving up valuations of private companies. But ironically, it's been the Magnificent Seven tech companies bidding up those companies instead of venture capital firms, just because the tech companies have so much financial firepower. So in all this, what's being missed, and the biggest thing is that there's going to be a massive increase in power consumption driven by all three. And unless it's clean power, then we're going to go backwards in terms of the goals for decarbonization. It's very hard to hit net zero when you're developing all this new technology that is very, very power intensive. The computing power required for the AI learning models is substantial, and we're getting more and more press talking about the increase of data centers that will be needed to support the new industry. And the reality is nobody really knows. There's some crazy numbers flying around. No doubt industry will adapt. I mean, NVIDIA's new chip is less energy intensive than the previous one, so there will be some adaptation. But it's pretty clear that the increase in power consumption will be substantial. And I mean, again, I won't throw out too many crazy numbers, but by 2026, 1/3 of Ireland's energy consumption will go to data centers. In the US, which holds 1/3 of data centers globally, in 2022, data centers consumed 4% of electricity in the US. 2026, it's estimated to be 6%, and by 2030, 10% of electricity consumed in the US will go to data centers, and that's McKinsey numbers. So what you have now is you have utilities globally scrambling around trying to figure out what is the demand forecast for energy, and the number is rapidly changing, and they're trying to figure out how do they fulfill this demand. And at the moment, the only source of clean baseload power that has been proven commercially is nuclear fission. And you'll hear more about this from Guy Keller later on today, I guess. But the market is in a supply deficit going forward, and with the forecast, just AI alone increase in demand, the 2030 supply deficit in uranium, 60% of that will be made up from AI-related demand. And that's assuming that nuclear maintains its role of providing 10% of global power. So in addition to the power consumption, all of these big investment themes rely on upstream commodity supply, and that's not really being factored into by governments. Because if you are effectively duplicating downstream capacity outside of China, then by definition you're increasing the demand for the commodities that are needed to feed that extra capacity. And there's no helicopter money going upstream. For example, a couple of weeks ago, Lithium Americas had a $2.3 billion loan from the Department of Energy in the US, but that loan can only be used for the downstream battery-grade lithium processing. It can't be used for the actual mining of the lithium. And so we could use a number of different commodities as an example. I mean, copper is the most ubiquitous. It's used in all kinds of energy transition applications. But we looked at the existing demand and supply curves for copper and added on incremental AI demand caused by increased data centers in particular, using an average of investment banking research. And we got the chart that you see there. And the base case, you see, it includes non-committed projects that we don't know if they will actually happen. Those are the lighter blue areas on the graph. And the dotted red line is the forecast increase in copper demand from AI-related data centers. And so that supply gap in 2030 is about 7 million tons globally. And to put that in perspective, the world's largest copper mine is Escondida in Chile. You can see it there. And that produces about 1 million tons of copper. And it's run by BHP in Rio. And so you potentially need 7 of those things to feed the increase in demand for copper alone. So if there is this problem, the question is, how will the supply gaps be solved? And there's a lot of money going into new technology, and it's very possible we'll have some big breakthroughs on the technology side. But the reality is, even the ones that do work, they will take years to be adopted commercially at scale by end users, because the simple reality is, when you're an end user whose business depends on a new technology, you need to be very, very sure that it's going to work before you spend the time and money and commercial risk in implementing it. And so nuclear fusion would be a good example of that. There's a lot of proponents of nuclear fusion, and hopefully it works, but our view would be that's at least 10 years away from being commercially proven at scale by end users. So there is a lot of capital going into new technology solutions, and some of it will work, but it's pretty hard to hang your hat on that being the solution in the near term. And so what if we use the current extractive industry model to fill the supply gap? But unfortunately, I think as a lot of people in the room know, the industry has some structural issues, and the first one is that it just keeps taking longer and longer to bring assets from discovery into production. It's currently over 15 years, and that number used to be closer to 10 years, so it's not getting any shorter. And so any first-year finance student can tell you that if you're pitching an investment that doesn't achieve cash flow for 16 years to an investor, that's a pretty hard sell. Another structural issue in the market is the financing model for junior exploration companies. It's been funded almost solely by retail investors in public markets. About 85% of the capital stack for junior companies is in retail hands on average. And on top of that, you have these early stage companies that go public too early. You have costs and management time and in being a public company that are probably not optimal for that stage of a company. So we need new sources of capital for early stage resources, sort of a venture capital type model where people will be willing to take risks in view of the outsized returns you get for the ones that work really well. And in my view, that probably needs to be led by governments and strategic end users who have the most vested interest in seeing that happen. But until the business metrics improve around developing assets into production, it's hard to sell that to anyone. And that's why governments need to lead the way in making the industry more investable in developing their natural resources. So The biggest thing that governments could do is to streamline the approvals and permitting process. And this is a global issue. It's in every jurisdiction that is extracting resources. And one of the biggest issues is you have conflicts and overlaps between federal, state, provincial, other stakeholders, and this duplicative process that can take longer and longer. And then there also needs to be increased accountability on the timeliness of approvals. And you can do all this without compromising on environmental standards. It's basically a question of cutting red tape. And if that can be done and you can reduce the amount of time that it takes to develop assets, then that's just finance 101. You have a much lower cost of capital for getting these projects out of the ground. So governments have shown they can act very quickly in times of crisis. We saw that during COVID. And so it remains to be seen if we're approaching one of those in the upstream extractive industries. The industry itself needs to do a better job of PR. The public is generally not aware of the good aspects of the extractive industry. They only hear the bad stories. I mean, the stat about Australian federal taxation covering the salaries of all the police and teachers in Australia, that's not widely known. There's dozens of countries around the world where mining contributes more than 10% to GDP. Australia's 10%, Indonesia's 12%, Mongolia's 20%, Chile's 15%, South Africa's 10%. And so the industry not only contributes substantial amounts of tax revenue and royalties, but it creates high-paying jobs, builds infrastructure, social infrastructure, et cetera. But it's also a very old industry. I mean, typically the industry is populated by, white guys in their 50s, and it needs to be made more attractive to the next generation of people. So then, what's the investment thesis? And we could look at a lot of things, but I think these are probably the two most impactful visuals. And commodities are very cyclical by nature. But the chart on the left shows what an extraordinary period of time we've been operating in. That's the Goldman Sachs Commodity Index against the S&P 500. And we've seen this protracted period of outperformance by the tech-led US equity markets. And it's hard to argue with the investment interest that these big tech companies are amazing companies, great businesses. You can't argue with that. But given the importance of extractive industries to the economy, it simply doesn't seem right that there's such a massive difference in the top 10 tech company valuations versus the top 10 battery materials valuations. I mean, the S&P 500 only has 2 mining companies. It has Freeport, Copper Company, and Newmont, Gold Company, and that's it. And so for contrarian investors, there's the very overused ice hockey expression from Wayne Gretzky that you want to be where the puck's going, not where it's been. And so, you can question whether big tech is where the puck's going to be going over the next 5 or 10 years. And we should all be reminded that the industry has shown that the sector can generate extraordinary returns in a bull market. Australia's 2 richest people made their fortunes developing iron ore that helped to fuel China's unprecedented growth and development over the past few decades. And make no mistake, it wasn't easy. People had to take risks. They had to, in some cases, get very leveraged for periods of time and find their way out of it. But more importantly than becoming multi-billionaires personally, they helped create wealth for the country through all the taxes and employment and development that spurred. And from John Rockefeller in the 19th century when he became the world's first billionaire and he founded Standard Oil, it's an industry that can create tremendous amounts of wealth and outside returns. And one could argue that a combination of this energy transition, decarbonization theme, geopolitical onshoring, and AI tech revolution in aggregate are much bigger demand drivers than China's industrialization. And so I'm going to leave a parting thought. 1 year ago today, this man, Tony, who will be presenting next, he will be presenting, and he spoke a year ago when his company was valued at 34 cents, and in that time it has gone up 10 times, and he looks very pleased with himself in the photo. I guess he knew something was going to happen. But they received a takeover bid from Chile's largest lithium producer, and Gina Reinhardt's Hancock Prospecting, which is some food for thought given the previous slide. So for the investors in the audience, you should be spending some time over the next few days going next door, meeting the companies, talking to them about their business, and you may find your next 10-bagger as well. So thank you very much for your time, and enjoy the rest of the conference. Thank you.